Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us is Dr. Wayne Winegarden, Senior Fellow in Business and Economics at the Pacific Research Institute, to discuss if a divided Congress can reach a deal to increase or at least suspend the debt limit. Dr. Winegarden, it's great to see you as always. Welcome back to Trade Talks.
It's great to be here. Thanks so much.
You got it. And it seems to be the only thing that Congress is bipartisan about is TikTok and not much else. So do you think a divided Congress can reach some sort of resolution regarding the debt limit?
They're going to reach a resolution. The question is, how much damage are they going to do before they reach that resolution? So what's the timing of it? And then what is the actual resolution? Is it going to actually be something meaningful, addresses our long-term structural issues, or is it going to be something that just kind of enshrines a lot of the excessive spending we've been doing?
So when you say we'll see how much damage they can do, what do you mean in terms of damage? Just the infighting, the optics around it?
Well, one, the optics, and two, if we have a government shutdown, especially depending upon how the administration prioritizes spending, there can be some serious economic damages, depending on what you prioritize. If you cut off checks going to senior citizens, things of that nature, that causes problems. You're not paying your vendors, that causes problems. The problems are even amplified more if all of a sudden we're not going to make good on our debt payments. So depending upon how that prioritization occurs, you can create real economic damage from hitting that debt limit and having to not be able to temporarily pay all your bills. Ideally, we'll get a limit. We'll get this done before we crash through. We already crashed through the limit, but before we are no longer able to pay all the bills, that's the ideal. We don't want to hit that deadline. But to me, that's the big question, and that's what I'm worried about, is that they're not going to strike a deal until after we've already kind of crossed over that threshold, and we're creating real harm in the economy.
What does that deadline look like?
I think we're talking about the summer right now. I think that's what Treasury Secretary Yellen said, sometime July, August. I mean, obviously that'll be flexible. I think I've heard it as early as June, but it's not that far away. And we're not talking about it that much in Congress. Like you said, Congress is talking about TikTok. They're talking about all sorts of things, but we're not hearing movement on these discussions, and hopefully we will soon.
Yeah, I guess it's so baffling for the average person such as myself to understand how they can keep raising the debt limit because they're not meeting obligations. I can't call Visa and say, hey, I exceeded my $10,000 limit. You need to raise it because I need to get my nails done, get my hair done. I'm behind on a car payment. It's so hard to wrap your head around how they're just able to raise these limits and continue to spend.
Well, I think the way to think about it, and the Visa is a great example. Imagine Visa gave you $100,000 limit. Okay, you've created an arbitrary limit. You're going to say, I don't want to spend any more than $2,000. And then you and the family have to have a vote every time you increase it. So there's more debt that you can put on, but you created this arbitrary limit. That's what the debt limit is. It's an arbitrary number that we've just capped ourselves. Most other countries don't have that mechanism. And in reality, when they vote for the budget, they vote for the debt because they're passing budgets that are unfunded. So this is just a strange mechanism that we have to limit, but it's self-imposed, which means we can lift it at any time we want to. And because we've already passed the spending, right? We've already passed how much we're going to spend. We already passed what the tax system is, and that spending well exceeds the revenues that are coming in. We have huge debts. So we've already, in effect, agreed to those debts. It just passed this arbitrary limit that we put on ourselves. And so now we have to raise that arbitrary limit because we've already made the decision to go into further debt.
Let's switch gears a bit and talk about what's happening with inflation and with the Fed. Why are tighter credit conditions a substitute for rate hikes?
Because it's all about the money supply. And so when you're raising rates, in effect, you're trying to increase the cost of banks to lend out money, so they lend out less money, and that helps kind of shrink the money supply, which we've actually, until just the recent banking crisis, we actually saw M2, which is a broader measure of money, has been going down for many months. When you have a reduction in the credit outstanding, when banks are in themselves not making these loans, that's going to shrink the money supply. So that's going to help when you shrink the money supply in the situation we're in now, where excessive money growth has stimulated artificial demand. And that stimulation of artificial demand relative to our productive capacities is why we've had the inflation. It's just a basic kind of supply demand mismatch. It's just supply and demand in the money markets. So that has caused the inflation. And so what we've needed to do is pull back the amount of money in the economy, reduce the money supply. The Fed rate hikes are one way to do that, and that's the typical way. But if we have this credit contraction, well, that's a lot more painful. That is certainly, if it continues to explode, is going to lead to recession possibly, or probably, and certainly weaker economic conditions. But that is a reduction in the money supply, and that will help kind of balance that money supply, money demand issue, reducing inflation. So it's just another way of doing it, a much more painful way, though.
Right. And of course, now we have to digest global banking stress. So the Fed doesn't meet again until May. What are some potential scenarios that could play out?
Well, it really depends on how the banking system kind of, what was the SVB and signature banks and Credit Suisse, is that more contained, or are we going to have a contagion? Is this going to spread out to other banks or other mid-sized banks at risk? If we continue to see the banking sector weak, if we see continued signs of contagion, the Federal Reserve is likely going to pause. Even if they don't pause, they have indicated that we're getting close to the top of the rate cycle, save over another bout of inflation, another surge in inflation. So, the most likely scenario is, my view, we're going to see a pause, and at the next meeting, they've indicated they're beginning to signal that, and they're going to wait and see. They're going to see how the banking system is going to fare out, and they're going to wait and see all of these rate increases that they put into the pipeline. How is that going to impact inflation? And then they'll make the decision kind of based off of where they see those trends going. If there's continued inflationary pressures, they'll probably have to continue the rate cycle. If the banking system continues to weaken, if there continues to be more bank failures, more stress and credit creation, then they'll pause longer and may even have to start cutting rates in order to kind of offset kind of the contagion that we've seen. It is important to note, though, that through their lending facilities, they are already very active kind of in the crisis. And we've actually seen money supply grow because they've been buying up assets. They've been taking on the assets of these weak banks, trying to stabilize the system.
All right. Dr. Winegarden, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.